Welcome, everyone. This is the discussion of the stock market, and we will start off with a section on private equity. This, as always, is Dr. J. Kent Gregory, and I'm using or following Jordan Miller and Dolvin's Fundamentals of Investments, the ninth edition, McGraw-Hill 2020. Well, first, a little background. Uh, because it's always good to know where things come from. On May 17th, 1792, there was the Button Tree Agreement. And this occurred in New York City, and it's the birth, in a way, the nascence of the New York Stock Exchange. And it was an agreement that was concluded among stockbrokers and agencies, and here is an image of the agreement itself. And it's essentially saying that we all agree that we will, uh, you know, honor each other's or honor this agreement and conduct trades amongst ourselves. And there were 24, I believe, signatories. Some of them were individuals and some of them were corporations. So on the left here, this is the document itself. And then this is an image of where it took place. Uh, Obviously a modern painting. But to talk about the stock market, first let's do an introduction and some basics here. And really what we'll be talking about is private equity. So honestly, what we'll be doing is stepping away for the moment from the stock market and talk about how maybe a company can get to an initial public offering. So private equity, this is really a broad term for the financing of non-public, typically smaller companies. So one of the ways that private equity is brought to the table is through venture capital. So we will often call this VC. This is financing for new, often high-risk ventures related to venture capital. In fact, very often venture capitalists are angel investors. And an angel investor would be an individual that provides capital for a startup in exchange for something like convertible debt or ownership equity. And then there are also business incubators, which is essentially a corporation that provides many of the services and the office space, things like that, that a new business needs. And usually it's at some sort of deep discount. And in exchange for that discount, the incubator receives an ownership stake in the, the small business or the startup business uh, that's that they are sponsoring. So there are private equity funds. Their structure is very similar to hedge funds. Both private equity funds and hedge funds are investment companies that are set up as limited partnerships. They pool money from investors to invest. They both charge a management fee and performance fee, and both hedge funds and private equity funds typically use the 220 fee structure. So 2% management fee on the assets every year and a 20% commission on whatever profits it receives. Now, the private equity funds have similar built-in constraints to prevent managers from taking or receiving really rather excessive compensation. And I use excessive in quotes because very often the managers of these funds, as well as with the hedge funds, make quite a bit of money. So there is a high water mark, and then there's also something called a clawback provision. And this is probably best described through this example. And this comes from page 137 of Fundamentals of Investments. So suppose a private equity fund is set up to have a 2-year life. In the first year, the fund earns 25% return right there. And then for every $1,000 in the fund, as a result, there's a $250 profit. So 25% of $1,000 is a $250 profit. Also, for every $1,000 in the fund, the managers receive a fee of $50. So this represents 20% of the $250 profit on every $1,000. But then in year two, the fund sees a 10% loss. So under the clawback provision, the managers have to give back, quote unquote, the first year's performance fee when the fund is liquidated. Now, remember, this fund is going to be liquidated at the end of the second year. At the liquidation, the managers earn a fee of $25 for every $1,000 in the fund. This is the 20% of the accumulated 2-year profit of 125. So because fund managers typically don't take performance fees until the fund is liquidated, the performance fee is known as carried interest. Remember, the fees reduce the net return to the fund. Investors must be accredited, and private equity funds are illiquid, even more so than hedge funds. So consider fund managers raise money and they invest it in companies that they can improve and hopefully take to an IPO, after which they exit. And so that whole process can take a number of years. Some types of equity funds. So venture capital, high risk but potential high return. So to limit risk, VCs will invest in stages. So for example, first stage financing might give money to build a prototype. Second stage, investment to begin manufacturing, marketing, and distribution. Sometimes VCs will give seed money. So this is an initial grant of money or an initial investment that the corporation or the business uses to get going. And then there's also mezzanine level financing. And remember, the mezzanine in a building is the level after the first floor, after the ground floor. So this is the mezzanine level financing occurs after the round level of the first stage. It can be debt or equity, so it can be preferred stock that can be converted to common stock, or it could be a bond with warranties and a call option. The funding in stages is a powerful motivator for the business owners, business founders. The founders often receive little in terms of salary, and they have lots of personal assets tied up in the business. And then VCs will often participate in running the company, which is a good thing. They have experience with startups typically, and they have business expertise and business experience themselves. And then there are middle market and leveraged buyouts. So many small regional private equity funds invest in middle market companies. These are ongoing concerns to established businesses. They have proven records. They're often small, family owned and family run, or they need money to expand, they need money to expand, or the owner wishes to retire. And so the fund will buy all or part of the middle market company. Then there's the leverage buyout, or LBO. So some background. Going public, this is where a privately owned company sells ownership shares to the public through an IPO. And then taking the company private rather, is exactly the opposite of going public. This is where a private company or person or a private entity purchases all shares of a corporation that's held by the public. So LBO, since often this kind of purchase requires lots of cash, a firm will borrow money to make the purchase. And back in the early 2000s, there was kind of a run of leverage buyouts. One of the famous ones is in 2007, the Blackstone Group bought Hilton Hotels for $26 billion. And of course, they borrowed money to do that. Well, thank you very much. I hope you enjoyed this discussion of private equity. And next, we will be talking about selling securities to the public. Thank you.